As you're sitting at your computer or scrolling on your phone, can you do one thing for me right now? Close every tab except this one. Yes, all of them. Even the incognito tab. And I'm not going to ask why it's open. I'll just assume you're researching investment strategies you don't want saved in your history. Yeah, let's go with that. Before we go any further, if you want calm, real-time breakdowns like this, hit subscribe, turn on notifications, and stay locked in, because the next update could land fast when this market finally snaps. The price on your screen, the number your broker shows you for COMEX spot silver, is not the real world. It's a story. It's a clean, comfortable figure generated by a computer in New York that has drifted away from physical reality. Because while that screen says silver is trading at $85 per ounce, on the other side of the world in Shanghai, China, the price buyers are actually paying for physical metal just hit $93.31. Let me say it again so it sticks. $93.31. That is the closing price for the afternoon session on the Shanghai Futures Exchange today. Not last week, not yesterday. Today, January 12th, 2026. And the spread between those two prices, the gap between the fantasy price in New York and the real price in Shanghai, is now $8.31, over $8 on a single ounce of silver. In a functioning market, that kind of spread shouldn't survive longer than 5 minutes. In a functioning market, every arbitrage trader on earth would be buying silver in New York at $85, putting it on a plane, flying it to Shanghai, and selling it for $93. They'd pocket an $8 risk-free profit on every ounce, and the gap would close within hours. But it's not closing, it's widening. And the reason it's widening is the most important thing you need to understand about the silver market right now. The arbitrage is dead. The bridge between the East and the West has been blown up. The metal that used to flow between these markets is no longer moving because there's no metal left to move. This is the day we've been warning about for years. This is the day the paper market dies. This is the day the system breaks. And you're watching it happen in real time. Let me walk you through exactly what happened today, because the numbers coming out of China are beyond extreme. The Shanghai Futures Exchange trades silver in 2 sessions. The morning session, which we call the AM session, and the afternoon session, which we call the PM session. This morning, the AM session closed at 91.13 per ounce. That was already a huge number. That was already well above the US spot price. But we've seen high premiums in Shanghai before, so it was notable, but it wasn't shocking. Then the PMS session happened, and something changed. The afternoon session opened, and the buying pressure wasn't just strong, it was overwhelming. Not just retail buyers, not just speculators, industrial buyers, corporate procurement officers, strategic orders. They were sweeping the order book. They were taking everything available at any price, and by the time the session closed, the price had ripped to $93.31. That's a $2.18 move in a single afternoon session. That's the kind of move you see in a currency crisis. That's the kind of move you see when a government loses control of its bond market. But this isn't a currency. This is a physical metal. And when a physical metal moves $2 in an afternoon, it's telling you the buyers aren't optimistic. They're desperate. Now compare that to what happened in the United States today. The COMEX spot price for silver, the price quoted on financial news, on broker platforms, on investment apps, closed somewhere around $85. I say somewhere around because it's moving minute by minute. But the key point is simple. The US is trading at least $8 below the Chinese market. $8. That's not a normal premium. That's not a harmless spread. That is a chasm. In commodities trading, an $8 spread on a fungible asset like silver is a market failure. It means the two markets are no longer connected. It means the price discovery mechanism has broken down. It means we are no longer trading in one global silver market. We are trading in 2 separate markets that no longer behave like they're related. And here's the terrifying part. The gap is not narrowing. It's expanding. 2 weeks ago, when we first started tracking this, after the Chinese export licensing system went live on January 1st, the spread was around $5. Last week it grew to $7. Today it hit 831s. What does that tell you? It tells you the pressure is building, not releasing. It tells you that every day that passes, Chinese buyers are willing to pay more and more above the Western price. It tells you they're not waiting for convergence. They're front-running the breakdown of the Western market. Why would they pay $93 when the spot price is $85? because they understand what the West pretends not to see. The spot price is increasingly irrelevant. The spot price is the price of a paper promise. The spot price is what you pay to buy a futures contract that might or might not deliver metal in 3 months. But the Shanghai price is the price of real physical silver, bars you can touch, metal you can load onto a truck, metal you can feed into a factory. In a world where vaults are empty, where delivery failures pile up, the physical price is the only price that matters. When I tell you silver hit $93 in China today, I'm not just describing a rally, I'm describing a repricing. I'm telling you the market is finally, after decades of suppression, discovering the true value of scarce physical metal in a world that desperately needs it. And this brings us to the question everyone is asking: why can't arbitrage traders close the gap? Why aren't the banks buying in New York and selling in Shanghai? The answer is simple and terrifying: because there is no silver to move. Arbitrage needs two things. First, you need price divergence. We have that. The spread is $8. Second, you need available supply. You need to be able to actually buy metal in the cheap market and transport it to the expensive market. And that's where the system is breaking. Because when banks try to buy physical silver in New York, when they try to stand for delivery on the COMEX, when they try to source bars from dealers, when they try to pull metal out of vaults, they're discovering the metal is not there. The registered inventory at the COMEX is down to around 30 million ounces. That sounds like a lot until you realize the open interest, the total number of paper claims on silver, represents hundreds of millions of ounces. So the metal that's supposed to back all those paper claims simply does not exist. It's been drained. It's been pulled out by the smart money who saw this coming months ago. And even if a bank could find silver in New York, they can't ship it to China because of the export licensing system. Once metal crosses into China, it's trapped. It does not come back out. The Chinese government has effectively built a one-way valve. Silver flows in, but it doesn't flow out. So the arbitrage isn't just hard, it's impossible. The bridge has been destroyed. The two markets are now floating free, disconnected from each other. This is the bifurcation we've been talking about for weeks. And today is the day it became undeniable. Now you might be thinking, okay, China is paying a premium, so what? Why should I care? I buy my silver in the United States. Here's why it matters to you. What's happening in China today is a preview of what is about to happen in the United States. The Chinese market is the leading indicator. It's the canary in the coal mine, and the canary just died. When Chinese buyers pay $93, while the paper market says $85, it tells you the paper market is mispricing the asset by $8. And eventually, the paper market has to correct. It has to catch up with reality. How does it catch up? Through a delivery squeeze, through a default, through a force majeure declaration, through one of a dozen different mechanisms that all end the same way. The paper price explodes upward to meet the physical price. And when that happens in New York, when the COMEX is forced to admit it cannot deliver the metal being demanded, the U.S. price is not going to drift slowly from $85 to $93s. It will gap. It will open at $95 or $100 overnight. Because once the illusion shatters, the real price is revealed. And the real price is whatever desperate buyers are willing to pay. So the Shanghai price today is not a foreign anomaly. It's a prophecy. It's showing you where the U.S. price is headed, and it's giving you a narrow window to prepare. But the Shanghai price is only one piece of the puzzle. Because while I was watching China go vertical today, I was also making phone calls. I was talking to people inside the physical silver industry in the United States, and what they told me should scare every person watching this. I spoke to executives at major bullion dealers, not mom-and-pop coin shops, but the biggest dealers in the country, the ones who feed the retail market, the ones plugged into mints and refineries. They told me, point blank, nobody has any silver. Those were the exact words. Nobody has any silver. Premiums, the extra amount you pay above the spot price to actually get physical metal in your hands, exploded today. Premiums that were $5 last week are now $8 to $9. And that's just the starting point for negotiation. One executive told me, and I'm quoting directly here, silver round premiums could go to $20 to $30 per ounce here. $20 to $30 on top of an $85 spot price would put the real cost of buying a silver round at 105 to 115s. And he wasn't guessing. He wasn't performing. He was staring at inventory sheets and an order backlog and telling me what the math is already saying. Because here's the reality. Private mints that produce silver rounds and bars for the retail market are overwhelmed. Orders in the last 2 weeks have exceeded anything they saw in the 2020 silver squeeze. And back then, they could ramp up production and catch up within months. But this time is different. This time, they can't get raw material. Refineries aren't selling to them. Refineries are prioritizing contracts with industrial users, the Teslas, the Apples, the solar panel manufacturers. The mints are at the back of the line, so the delays are exploding. If you order a silver round from a private mint today, you're looking at an 8-week delay, 8 weeks, 2 months. And that's assuming the mint doesn't run out of silver entirely and have to refund your order. Think about what that means. If you want to buy physical silver right now, you have 2 options. Option 1, buy from a dealer who has inventory and pay an insane premium. Option 2, place an order with a mint, wait 2 months, and hope they can actually fulfill it. Neither option is good, but option 2 is basically gambling. You are betting the system holds together for 8 more weeks. You're betting the mint can source the silver. You're betting the price doesn't explode to $150 while you're waiting, making your locked-in price meaningless because you could have just bought at the market at that point. So if you want silver, you're going to pay the premium. There is no other choice. The spot price on your screen is a fantasy. The real price, the price you actually have to pay to get metal, is already pushing $100. And this brings us to a very uncomfortable truth most investors don't want to admit. The price you see on TV is not the price of silver. It is the price of a derivative of silver. It is the price of a futures contract. It is the price of an ETF share. It is the price of a paper promise. But when you try to convert that paper promise into actual metal, you discover the conversion rate is not 1-to-1. You discover the paper says $85, but the metal costs $100. This is the paper to physical premium, and it's exploding right now. Why is this happening? Why are premiums so high? Because dealers are not stupid. They know what's coming. They see the same data you see. They see the Shanghai price. They see the delivery failures. They see the COMEX inventory drained, and they are pricing in the future. They know the silver in their vault today will be worth far more next month, so why would they sell it to you cheap? They're holding out for the higher price. They're rationing inventory. They're waiting for the spot price to catch up to physical reality. And when the spot price does catch up, when the COMEX finally admits the paper market is broken, dealers who held inventory will make a fortune. They'll sell at $120 or $150. They'll look like geniuses, but investors who waited, who believed the spot price, who told themselves they'd buy the dip when silver pulled back to $75, those investors will be left with nothing, because by the time they try to buy, the metal will be gone. This is the supply shock we've been warning about, and it's here. Not next year, not next month. Here, today. Now let's zoom out for a moment, because this silver squeeze isn't happening in isolation. It's happening at the exact same time as a historic move in gold. Gold hit an all-time high today. I don't have the exact number in front of me, but it's somewhere north of $4,600 per ounce. That is a massive breakout. That is gold screaming that something is very, very wrong with the global financial system. And when gold and silver both rip to all-time highs at the same time, it's not a coincidence. It's not just commodities. It's a signal. It's the market voting with billions of dollars that the fiat currency system is failing. Now here's what most people miss. When gold and silver go vertical like this, they don't just compete with stocks for investor dollars. They do something more destructive. They create a liquidity black hole. Here's how it works. The global financial system is built on risk-free assets. At the base of the pyramid, you have U.S. Treasury bonds. These are treated as the safest assets in the world. They pay a guaranteed interest rate, and that rate is used to value everything else. The Treasury bond pays 4% interest. A stock has to compete with that bond, so the stock must offer higher return to justify risk. That difference is called the risk premium. And every stock, every corporate bond, every piece of real estate is valued relative to the Treasury rate. But what happens when gold and silver, the ultimate risk-off assets, start outperforming treasuries by a massive margin? What happens when gold is up 30% in a year and silver is up 170% while treasuries are losing money because yields are rising and prices are falling? It breaks the model. Investors look at it and say, wait, why am I holding treasuries that pay 4% and lose value when I could hold gold that pays nothing but rises 30%? And they sell treasuries, they sell bonds, they move into hard assets, and when treasury prices fall, yields rise. When yields rise, borrowing costs rise. When borrowing costs rise, companies cut spending, consumers cut spending, and the economy slows. But it goes deeper. Stock valuation models break too because stocks are priced using discounted cash flows. You take future earnings and discount them back to the present using the risk-free rate. When the risk-free rate rises, the present value of future earnings falls. So even if a company earns the same money, its stock price has to fall to reflect a higher discount rate. This is why gold and silver going vertical is dangerous for the stock market. It's not only money leaving stocks, it's the entire valuation framework cracking. And we've seen this setup before, 3 times in recent history: 2000, 2007, 2019. Every single time, gold and silver surged to new highs, treasuries sold off, and within 6 months, a major recession hit. In 2000, the dot-com crash. In 2007, the housing bubble bursting. In 2019, the repo crisis that led directly into the COVID crash. And now, in 2026, we are seeing the same signals. Gold and silver at all-time highs, treasuries under pressure, and a Federal Reserve that is completely trapped. Which brings us to the elephant in the room, Jerome Powell. As I was preparing this video, news broke that there is a criminal probe into Federal Reserve Chairman Jerome Powell. The probe is tied to concerns about Federal Reserve independence and potential conflicts of interest. I'm not going to speculate on the details. I'm not a lawyer and I don't have inside information. But I can tell you this, the fact that the chairman of the Federal Reserve is under criminal investigation at the exact moment financial markets are falling apart is not nothing. The Fed is losing credibility. The market is losing confidence. And when the market loses confidence in the central bank, things can move fast, violently fast. Here's the trap Powell and the Fed are in. They have 2 choices, only 2, and both lead to disaster. Choice 1, print money, cut rates, restart quantitative easing, inject liquidity to stop a deflationary collapse. That can save stocks short term. It can prevent recession. It can keep banks alive. But it destroys the currency. It pushes inflation out of control. And it sends gold and silver vertical because every dollar printed makes hard assets more valuable. If they choose this path, silver doesn't stop at $100. It goes to $150, $200, maybe higher. Choice 2, don't print. Hold rates high, let bad debts fail, let zombie companies go bankrupt, let housing crash. This restores discipline, purges excess, and sets the stage for recovery. But it causes a depression. Stocks crash, unemployment spikes, credit freezes, banks fail. If they choose this path, silver might dip briefly in the deflationary panic, but it will surge even higher over time because credibility will be gone. The dollar will be finished. People will flee into hard assets as the last store of value. So the Fed is trapped. They can't print without crushing the currency. They can't not print without crushing the economy. And the market knows it. The market sees Powell under investigation. The market sees the Fed losing control. And the market is voting with its feet. It is exiting the dollar. It is exiting treasuries. It is piling into gold and silver. This is the confidence crisis we've been warning about, and it's accelerating. Now let me bring it back to silver, because the Fed's trap hits silver directly. If the Fed prints, silver goes vertical through currency debasement. If the Fed doesn't print, silver goes vertical through flight to safety and industrial shortage. Either way, silver wins. This is why I tell people silver is the most asymmetric trade on the planet right now. You're not betting on one outcome. You're betting on a range of outcomes that all point to higher prices. The only scenario where silver truly loses is if the Fed threads the needle perfectly, prints just enough to avoid a crash, but not enough to spark inflation. And then somehow a flood of new silver supply hits the market from new mines. What are the odds of that? Close to 0. So the risk reward is skewed hard in favor of the silver holder. Your downside might be 10 or 15% in a short panic. Your upside is 100% or more. That's an asymmetric bet, and asymmetric bets are the only bets worth taking. But here's the critical point. The window to take that bet is closing fast. 2 weeks ago, you could buy silver at $75. Last week, $80 with a smaller premium. Today, you're paying $85 spot plus $8 or $9 premium. That's $93 or $94 all in. Next week, maybe $105. The week after that, you might not be able to buy at all because dealers will be sold out. This is the escalator effect. The price moves up one step at a time. Every time you hesitate, every time you say, I'll wait for a pullback, the escalator moves up another step. And one day you look up and realize you're 10 floors behind. So if you've been waiting for the perfect entry, here's the truth. The perfect entry was 2 years ago at $20. The good entry was 6 months ago at $30. The acceptable entry was 2 weeks ago at $75. Today, $93 to $94 all in is still reasonable if you believe the thesis. But it's not perfect, and it gets worse each day. So ask yourself, do I believe silver is going to $150 or $200? If yes, paying $94 today is fine. You're buying at a discount to the future price. But if you wait for a dip that never comes, you'll be the person watching silver at $200 thinking, I should have bought at 94. Don't be that person, decide now. Now let's talk about how you should be buying silver in this environment, because the strategy that worked 6 months ago doesn't work the same anymore. 6 months ago, you could buy an ETF like PSLV and feel relatively safe. It tracked the price, it was liquid, it was convenient. Today, buying PSLV is a gamble because PSLV is backed by physical silver held in a vault by JP Morgan. And we don't know if that silver actually exists for you. We know JP Morgan has a private hoard of 750 million ounces. But we don't know if they're using that hoard to back the ETF or keeping it for themselves. And more importantly, we know the PSLV prospectus has a clause that allows the custodian to cash settle during a market disruption. So if the COMEX breaks, if deliveries fail, if vaults are empty, PSLV can hand you cash instead of silver. And what good is cash if silver is trading at $150 and you get paid $85? So PSLV is a risk. And in a world where the physical market is cracking, I do not recommend taking that risk. The safer option is PSLV, the Sprott Physical Silver Trust. PSLV is domiciled in Canada. It stores its silver at the Royal Canadian Mint. It allows physical redemption if you hold a large enough position. It has a more transparent auditing process than PSLV. Is PSLV perfect? No, but it is better than PSLV. The best option, of course, is physical silver in your possession. Coins, bars, rounds, stored in a safe at home or a private vault you control. Yes, you'll pay a premium. Yes, storage and security are real, but you will actually own the asset. And in a world where paper markets fail, ownership is everything. So if you're buying silver today, buy physical, pay the premium, accept the inconvenience. Because the inconvenience today may save you from catastrophe tomorrow. And if you can't afford physical, if premiums are too high, then at least buy PSLV instead of PSLV. Give yourself a fighting chance. But whatever you do, do not sit in cash. Do not sit in treasuries. Do not sit in a money market fund earning 4% while the world burns around you. Because the Shanghai price today, $93.31, is a warning. It is a signal that the paper market is dying. It is a signal that the physical market is the only market that matters, and the gap between the two will keep widening until the paper market finally breaks. Now let me give you the timeline as I see it, because people always ask, when does this happen? When does the COMEX break? When does silver hit $150? I don't have a crystal ball, but based on the data, the Shanghai premium dealer inventories, I believe we're looking at weeks. The delivery notices for January are going to be released soon. If they show a surge in demand, if they show a large number of contracts standing for delivery, it will trigger panic. The market will realize the COMEX does not have metal to deliver, and once that realization lands, the price will gap up violently. I'm talking about a $10 or $15 jump in a single trading session. I'm talking about silver opening at $100 on a Tuesday morning because something broke over the weekend. And when that happens, premiums on physical will blow out even more. Dealers will charge $20 or $30 over spot. Mints will stop taking orders. Retail buying will effectively shut down. And if you do not already have your silver by then, you're not going to get it. You will be stuck watching the price run to $150, $200, knowing you could have bought it at $94 if you had acted. So the time to act is now, not tomorrow, not next week. This is your Lehman Brothers moment. But instead of a bank collapsing, it's a commodity market collapsing. And the Fed can't save it by printing more dollars because you cannot print silver. The Shanghai price today, $93.31, is the smoking gun. It's the proof the system is broken. It's the proof arbitrage is dead. It's the proof the markets have split into two realities. The Western market is living in fantasy. The Eastern market is living in reality, and reality always wins. So get out of the fantasy, get out of paper, get out of ETFs that might not deliver, get out of futures contracts that might get cash settled, get into the real, get into physical, get into metal you can hold. Because when this system breaks, and it is breaking right now, the people who own physical silver will be the winners, and the people who own paper promises will be the losers. The choice is yours, but the clock is ticking. The Shanghai price just hit $93. The US price is at $85. The gap is $8 and widening. How much wider does it have to get before you treat the paper price like the warning it is? And what decision are you making today because of it? Let me know in the comments below.